Hi, this is Mike Mock with the morning comments for the Lansing Trade Group on Thursday, November 10th. We've had two significant events over the last week, and we want to take a look back at this. Obviously, the election, the U.S. presidential election, was very important earlier in the week. We want to come back to that in a minute. The second thing here on Wednesday, we had the monthly USDA WASDE report, the balance sheet update that included production evaluations here. We're now down to where the final evaluation will come in January, and we'll put this crop size to bed. But clearly the market was surprised at how aggressive the USDA was with their yield estimates, particularly in corn, with a significant improvement in the Northwest Belt. North Dakota, one state, up 17 bushel month on month. It's a huge increase, but reflective of the great weather that they had all season. So a 175 plus bushel bean or corn yield relates to a carryout now that's north of 2.4 billion. There's no other way you can categorize that as negative to price. A situation in beans also, a yield bump over a bushel this late in the season is almost unheard of. But again, yield reports from the growers across the country continue to astound, and now we've got a 52.5 bushel soybean yield and a carryout that's now climbed to 480 million. Again, also bearish, and the situation in wheat continues to be negative, not only in the U.S. but globally with excessive inventory. So there's no way that you can categorize the numbers from the government Wednesdays anyway, but with a bearish lean. Now, that's just one side of the equation. We don't trade grains in a vacuum, and we have to remember that. The situation coming off the election is entirely different, and I'm surprised at how aggressive the market has traded certain markets since the election. Obviously, we're still a ways off before President Trump will be indeed installed as the 45th president of the U.S. But in the interim, the market's taking no prisoners and making some significant changes. We touched on this yesterday. It's really important to know or to monitor where the flow of the money is, and we can see some significant adjustments, and the trade is beginning to anticipate a reflationary kind of environment with a lot of infrastructure spending in the U.S. Now, there's a bit of a counterbalance to that in terms of what he'll do with trade agreements. That could be seen as a negative to growth, but the market's running with the reflationary story, and you can see it in a market like copper, which has just exploded after trading 205, 210. It's up to 245 this morning. Also seeing it reflected very dynamically in the bond market, which is obviously a huge market, and money flowing that direction as well. What we've done is steepen the curve. For a grower, it might be easier to understand in terms of building the carry. So short-term rates have not done much, but the back end, the 10-year and the 30-year note, have gone up significantly just in the last 24 hours. So the trade is concerned that the cost of money is going up. The lean would be that the Fed now will go in December and perhaps raise rates a couple times next year, and that the 10-year note, which was 1.36 during the summer, is now 2.06 this morning, and maybe indeed over the next year and a half, 2 years, be headed to 3%. Still not a huge number from a historical perspective, but a significant change, as we shift gears, into this pro-growth kind of environment. So there'll be pressure to see if we can actually get this through Congress. I would be quick to point out that there were 8 Republican senators that admitted publicly that they did not vote for Trump as president. So there still can be some hiccups along the way. But what we're suggesting to our grower customers is we've got two factors going different directions. The grain isolated by itself, the balance sheets are clearly negative, both in the U.S. and globally. That should keep a lid on any kind of major runaway in prices. So especially in old crop, on a 10, 15 cent bounce in corn, 20, 25 cent bounce in wheat, similar kind of situation in beans. Up to these recent top end of these trading ranges, we think the farmer has to be active in selling, cleaning up his old crop bushels. And again, if given the opportunity, just to throw out some numbers, if we can get the Dees 17, we call it the red Dees contract, up to 395 again, anywhere close to $4, which would be 10 cents higher than last year's February average, we want to look at some things like a minimum, maximum, 380, 430 kind of floor ceiling strategy. Similar situation in beans. If we get the November of 17 contract back to $10 or higher, let's look at some 960, 980 floors financed with some 1060, 1080 ceilings as a way to get started. Because again, we've got two different tugs. The grain information is negative. The macro reflationary information is supportive. But again, we think that'll have an impact impact on more markets, other markets, rather than just the grain. So again, be cautious in this environment. That's all I got for you today. You have a great Thursday. I'll talk to you first thing in the morning.